Hey everyone, welcome back to Corporate Decoder. Today, DWS Massachusetts Tax-Free Fund just filed its annual shareholder report for March 2026, and there is a lot to unpack from bond performance to fee structures. Quick note, this is not financial advice, just my take on public filings for educational purposes. This report gives us a really clear picture of how the fund performed last year and what caused those results, and we will dig into the numbers to see if this fund is still a good bet for tax-free income. Alright, let's start by looking at the top line, the big picture for the DWS Massachusetts Tax-Free Fund. This filing covers the period from the 1st of April 2025 to the 31st of March 2026. It looks like this fund offers several classes of shares: Class A, Class SE, Class S, and Institutional Class, and they each have their own performance and cost profiles. One of the first things investors always want to know is about costs, especially for mutual funds. Here we see a breakdown for a hypothetical $10,000 investment. For Class A shares, the cost was $89 or 0.87%. This is based on a gross expense ratio from their latest prospectus of 0.96%. They also mentioned that without certain waivers or reductions, the costs would have been higher, so it pays to keep an eye on those waivers. Now for Class C shares, those costs jump to $164 for a $10,000 investment. That is 1.62%. This is higher than Class A. And it makes sense because Class C shares typically have higher ongoing expenses and a contingent deferred sales charge, or CDSC. If you sell them too soon, their gross expense ratio in the prospectus was 1.77%. Waivers were likely at play here. Class S shares, on the other hand, come in much cheaper at just $63 for that $10,000 investment. That is 0.62%. Their prospectus shows a gross expense ratio of 0.777%. Institutional class shares were even lower at 0.62% as well, with a gross expense ratio of 0.75%. So if you are cost-conscious, Class S and institutional seem like the way to go. Now for the performance class, A shares returned 3.65% for the period. This is actually below the broader Bloomberg Municipal Bond Index, which returned 4.29%, and also below their more specific index, the Bloomberg Massachusetts Exempt Municipal Bond Index, which returned a stronger 4.53%. This underperformance seems to be linked to a few factors the report mentions. The municipal bond market saw heavy new issue supply last year, which can put pressure on prices, but surprisingly strong demand from tax-free exchange, traded funds, and separate accounts helped offset that. The report highlights that the fund's duration positioning, which is basically its sensitivity to interest rate changes, actually hurt its performance compared to that Massachusetts-specific index. When interest rates rose, longer-term municipal bonds that the fund was holding saw their prices fall. Another key point is the fund's exposure to lower-rated bonds. They were overweight in BBB and below. Investment-grade issues this weighed down returns because those lower-quality segments of the market did not perform as well as higher-quality ones, on the flip side being overweight in senior living, and higher education bonds actually helped their performance, so it was a mixed bag there. Let's look at the long-term growth of an assumed $10,000 investment. This table shows how your money would have grown year by year starting from 2016. We can see the class of shares often trail the indices, especially when you account for sales charges. The numbers show a general upward trend for the indices over the years, but Class A often lags behind. Looking at the average annual total returns is crucial here. Class of shares, unadjusted for sales charges, show a 3.65% return for the last year, but when adjusted for the maximum sales charge of 2.75%, that return drops to just 0.80%. That is a huge difference, the 5-year and 10-year returns for Class A are also significantly lower than the indices after accounting for those sales charges, and fees. Class C shares perform similarly with their adjusted one. Year return at 1.87%. Here we have some key fund statistics. Net assets are around $182 million with 114 portfolio holdings. The portfolio turnover rate is 38%, which means they bought and sold about 38% of their holdings last year. This is a moderate level of turnover. Total net advisory fees paid were over $716,000, and the modified duration to worst is 6.8 years, indicating a fairly significant sensitivity to interest rate changes. A longer duration means bond prices can move more dramatically when rates change. Now let's dive into what the fund actually invested in terms of asset allocation. 75% of the net assets are in revenue bonds and 18% in general obligation bonds. Lease obligations make up 6% and variable rate demand notes are 3%. The remaining 2% is in other assets and liabilities net. Looking at credit quality, which is super important for bond funds, a significant portion. 52% is rated AAA rated bonds make up 13%, and rated bonds are 18%. However, there is also exposure to BBB, which is 4%, and even BB, which is also 4%. These are lower investment grade and below investment grade ratings respectively, and 5% of the holdings. are not rated at all. This aligns with the performance commentary about being overweight in lower quality segments. This section shows the actual holdings, and this is where we see the real detail. For example, we see a large position in Massachusetts general obligation bonds with a 5.0% coupon maturing in 2048 valued at over $5 million. They also hold various revenue bonds from entities like the Massachusetts Development Finance Agency and Massachusetts Port Authority. Many of these are long term bonds with coupons in the 4 to 5.5% range. We also see holdings like the Massachusetts State Transportation Fund, revenue bonds with a 5.0% coupon maturing in 2048 valued at over $1.5 million. And importantly, for an inverse floater strategy, they hold Massachusetts Commonwealth Transportation Fund revenue bonds, which are inverse floaters. The value here is over $5 million. Moving on to the statement of assets and liabilities on the 31st of March 2026. The fund's investments were valued at over $183 million. Liabilities include a significant amount payable for floating rate notes issued at $3.75 million. This is directly related to their inverse floater strategy. As noted in the investment section, the fund's net assets are about $182 million. The net asset value per share for all classes, Class A, Class A, Class S, and institutional was $13.02. This is consistent across all classes, reflecting the overall performance of the fund's holdings. However, the offering price for Class A shares is higher at $13.39 due to the sales charge. Class C shares are subject to a contingent deferred sales charge when redeemed within a year. The statement of operations shows a net investment income of over $6.1 million. Interest income was about $7.4 million. Expenses before reductions were around $1.5 million, but expense reductions brought that down to about $1.2 million. The fund also saw a net realized gain of over $1 million from investments, and investments gained about $1.7 million in unrealized appreciation for the year. This resulted in a net increase in net assets from operations of over $7.2 million. Looking at the statements of changes in net assets for the year ended the 31st of March 2026, the net increase from operations was over $7.2 million. However, distributions to shareholders were over $6.1 million, and there was a net decrease in net assets from share transactions of over $21 million. This means that overall the fund's net assets decreased by about $20.5 million, but the prior year 2025 saw a similar decrease of over $28.5 million. Now let's look at the financial highlights for each share class. For Class A shares, the total return for the year ended the 31st of March 2026 was 3.65%, but remember that is unadjusted for sales charges. The total return adjusted for sales charges for the year was 0.80%, and their 5-year adjusted return was actually negative at minus 0.5%. This shows the impact of fees on long-term performance. Class C shares had a 1-year total return of 2.87% unadjusted for sales charges. Their adjusted 1-year return was 1.87%. For the 5-year period, their adjusted return was minus 0.68%, which is also negative. So similar to Class A, those sales charges and higher ongoing expenses have a real impact on returns over time. Class S shares with no sales charge had a 1-year total return of 3.90%. Their 5-year return was 0.31%, and their 10-year return was 1.63%. These are better than the adjusted returns for Class A and C, but still lag behind the benchmark indices slightly. The institutional class also showed a 1-year return of 3.90% on a 5-year basis. It was 0.31%. And since inception in December 2020, it was 0.25%. This class had the lowest expense ratio, which is why its performance is closer to the unadjusted numbers for other classes. The notes to the financial statements provide more detail. For instance, they explain the organization of the fund, its multiple share classes, and how investment income and expenses are allocated among them. Security valuation is done at fair value using observable inputs for municipal bonds, which is generally categorized as level 2. A significant part of the fund's strategy involves investing in inverse floaters. These are complex instruments where the interest rate has an inverse relationship to short term interest rates. The fund effectively uses leverage through these instruments, which magnifies both potential gains and losses. They are accounted for as a form of secured borrowing, with the value of the underlying bond reflected as an investment and the amount owed to a floating rate note holder as a liability. For the year ended the 31st of March 2026, 100% of the dividends paid from net investment income were designated as exempt interest dividends for federal income tax purposes. This is the primary goal of this fund, but they do mention that a portion of distributions may be subject to federal, state, and local taxes, including the alternative mini Tax. This section details how the fund's Board of Trustees evaluated and renewed the investment management agreement with DWS Investment Management Americas Inc. or DEMA. They considered factors like the nature and quality of services, fees and expenses, profitability, and economies of scale performance data was compared against market indices and peer groups. And while the fund's performance has been mixed, relative to benchmarks, the board concluded that the agreement renewal was in the best interest of the fund. The independent auditor Ernst & Young LLP confirmed that the financial statements present fairly in all material respects. The financial position of the fund they conducted their audits according to PCAOB standards and found no material misstatements. Let's think about the story here, the DWS Massachusetts Tax. Free Fund aims to provide tax-exempt income from Massachusetts municipal bonds. It had a challenging year, relatively speaking, trailing its benchmark indices. This seems linked to its duration positioning and its exposure to lower rated bonds. The Class A and C shares show the significant impact of sales charges and higher ongoing fees on long-term returns compared to Class S. And institutional shares, the fund's use of inverse floaters adds complexity and leverage, which can be a double-edged sword, meaning higher potential gains, but also higher risks overall for investors looking for stable tax. Free income from Massachusetts municipalities. The data suggests that while the fund has a long history and experience management, its recent performance and fee structure, especially for Class A and C shares, might make investors consider the lower cost options like Class S or institutional class, or even compare it carefully against its benchmarks and other investment alternatives. Key takeaway is that the actual realized returns for investors in higher cost share classes were quite a bit lower than the stated market returns. Due to those fees and charges, it is always important to look past the headline numbers and see what you are really paying and what you are actually getting back. That is my take, stay decoded.